Hello, I'm Celia Anderson, President of the CFA Society Atlanta. Welcome to today's panel discussion, Boom, Bust, or Fizzle, How Investors Should Think About SPACs. Special thanks to our partner CFA Institute for their support with today's event. Before we get started, just a few programming notes on other upcoming events. First, as part of our online career series, please join us on December the 2nd for our webinar, Take Control of Your Career. Next, we will be closing out the 2021 year with our annual holiday mixer, which will be in person on the evening of December 9th. We'll then kick off 2022 with our online soft skills series regarding the art of public speaking on January the 25th. And last but not least, we'll be hosting our 18th annual forecast dinner on the evening of February 3rd. Our featured guest will be political scientist, author, and president of the Eurasia Group, Ian Brimmer. We would be delighted for you to register for any or all of these events at our website. Now, on to today's impressive panelists. We are pleased to be joined by Usha Rodrigues, Stephen Deane, CFA, and Karina Karakulova. Usha is a university professor at the University of Georgia School of Law, where she is the M.E. Kilpatrick Chair of Corporate Finance and Securities Law. Stephen is the Senior Director, Capital Markets Policy for CFA Institute. And Karina is the Senior Manager of Capital Markets Policy Americas, also at CFA Institute. Both Usha and Stephen testified before the House Financial Services Committee on SPACs and related topics last May. Please visit our panelists' more extensive bios online. Today's event will be moderated by Christine McKay, CFA, who is a trustee and the Career Development Chair at our society, as well as an adjunct professor at Emory University School of Law. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I will turn it over to Christine to begin. Christine?
Great, thank you, Celia. Well, it's exciting to have this panelist with us, and thank you for introducing them. Today, our topic is special purpose acquisition corporations, better known as SPACs, sometimes called blank check companies. This is a low-cost vehicle for private companies to go public. They allow retail investors to get in on the ground floor, which traditional IPOs didn't always allow. So basically, who wouldn't love these? So let's learn some more about them. And to start that out, Karina is going to do a nice presentation for us of pre-2020, what was going on with SPACs, and then more current market trends of SPACs. So we'll start out with that, and then we'll get into the panel.
Great. Thank you, Celia, and thank you, Christine. And it's great to be back here with CFA Society Atlanta. Let me share my screen and make sure that all the tech is working. Can you all see that? Excellent. So I thought that before we actually dive into the data on the SPAC market, that maybe it would be good to set the scene a little bit on the terminology that we commonly use when we talk about SPACs, and that I think will also be echoed by Christine, Stephen, and Usha during our discussion today. First, as Christine, as you were saying, SPACs are special purpose acquisition companies. In their simplest form, SPACs are, exactly as you said, a blank check company that a SPAC sponsor forms with the express purpose of taking a private operating company public through a merger with the SPAC. Typically, a SPAC sponsor has 18 to 24 months to find a company to take public, to then actually close the merger. Shareholders have the right to vote up or down on the deal. If the deal goes through, the target company becomes a public company. If the deal doesn't go through, the SPAC liquidates and the SPAC sponsor loses their initial investment. There are a couple of transaction points here that I want to highlight that I think are of a special note. At the SPAC IPO, the SPAC sponsor typically advances $25,000 as an investment in return for what is known as a promote or the founder shares. And this is equivalent to 20% of the SPAC's post-IPO equity. IPO subscribers, which historically have been hedge funds, also known as the SPAC mafia, get $10 units. Units comprise a common share and a fraction of a warrant. And after 52 days, the units separate and the SPAC shares and the warrants trade separately. The IPO proceeds are placed in a trust, accrue interest, and are generally ring-fenced and so cannot be touched until the merger actually happens. At the business combination announcement, one thing that we've been discussing a lot, and I want to flag, it's very interesting to note that when a SPAC sponsor announces the business combination and the merger that they are seeking to make, at this point, the target company, neither the target company nor the SPAC sponsor have officially filed all of the paperwork, or the SEC has not yet fully validated the paperwork that has been filed to validate the due diligence and the completeness of the disclosure on the target company. So in effect, we have the SPAC trading purely on the news, or in some cases, the hype around the target company that hopefully will go public. But as we've seen recently, the announcement of a business combination is no guarantee that a business combination will actually go through. At the shareholder vote, as I mentioned, shareholders have the right to vote up or down on the deal. But what's unique here, and what Usha's research really focuses on, so I want to set up her research here a little bit, is that as a shareholder, you have the right to vote up or down on the deal. But there, in many cases, and this is actually a really frequent occurrence, shareholders can, and often do, vote for the deal, at the same time redeem their shares, so they get the $10 that they initially invested, plus the interest that accrued in the IPO proceeds that were placed in trust. And they also get, because the deal goes through, they get to keep the warrant. So this optionality is something that's commonly referred to as the default free convertible bond, because you have the floor of the redemption value, but you also have the additional kicker of the warrant. I'll also mention here, because we'll come back to it a little bit later, that the redemption distribution tends to be bimodal. So if the redemption value, that is the $10 plus interest, is greater than where the SPAC is currently trading, then the most economic decision for any shareholder to make is to redeem, so exit the transaction. And we see that quite frequently. In the next few slides, I want to go back through some of the SPAC history. So many of us who have been following the SPAC market know that SPACs have been around for decades, whereas they have been mostly dormant through the 1990s, and we saw a mini boom in the early 2000s. None of that has ever matched the real boom and enthusiasm that we saw at the end of 2020, and most especially at the start of 2021. It's also notable to note that 2020 all around, despite it being the year of the pandemic and half of the year we had a global economic shutdown, in the second half of the year, we saw IPO activity globally and in the US substantially pick up. In the US, we had more than 400 US IPOs. That was the highest number that we had seen in 20 years. More than 50% of that came from SPACs. And as if that enthusiasm wasn't great enough, in 2021, in the first quarter of 2021, especially January and February of this year, SPAC issuance was greater than for the entire year of 2020. And you can see that in the chart here. So in gray is are the numbers that refer to SPACs, and in red, the traditional IPO volume. So you can kind of see the comparison between the two. Since January, February of this year, the SPAC market has considerably slowed down. So we're something on a roller coaster of where the SPAC market was and where it is currently. And here I want to relay some of the data that we're now seeing. So on the left, we're looking at the performance of recent SPAC deals, live deals in blue, and deals that closed in 2021 in red. It may be a little bit difficult to see, but I can give you some context. So on deals that are currently live, that is in blue, the common stock price for these deals has recently been improving. Nonetheless, most of these deals are trading below trust. So they're trading below $10. And prices for deals that closed this year, I think very clearly you can see from the red dots, the majority of them are trading below the $10 trust value that is pre-de-SPAC. At the same time, where we've seen the SPAC market sentiment cool down considerably, we're also seeing for SPAC sponsors that the deal count in general, the overall deal environment is not what it used to be, and it's increasingly more difficult for SPAC sponsors not only to close a deal, but to also obtain the additional what's known as PIPE financing. This is private investment and public equity financing in order to help supplant the IPO trust money that they have already put together. And generally, I should also mention that PIPE commitments come from the institutional investors, so from the BlackRock's, Fidelity's, T. Rowe's of the world, and their commitment not only provides additional funding for the deal, but is also seen as something of a validator of the quality of the deal. So on the right in red are the bars attributing to the PIPE commitments. And again, you can see January, February, we saw a lot more PIPE coverage and a considerable drop since then. So between a dampened SPAC market sentiment, tighter deal financing conditions, we're also seeing the additional kicker, and this is also something that Usha's research has shown, we're seeing much higher redemption ratios. I mentioned earlier that the most economic decision that an investor can make at the de-SPAC is if the redemption value is greater than where the SPAC is currently trading, then you're going to redeem. And because the SPAC market has, over the summer months and the early fall months, have generally meant that most SPACs are trading below $10. This has meant that most investors are going to redeem. So you see that in the first bullet point here, where I'm summarizing essentially the point that I made, which is that redemption ratios are highly correlated with where the SPAC market currently is, and further, they are bimodally distributed based on where the SPAC market is. I want to show some of the data for the deals that have closed in recent months and what the redemption ratios have been. So here are all the deals that closed in June and the percent of shares that were redeemed. For July, we see fewer deals closed and substantially higher redemption ratios. August, more than 50% of the deals that closed had a 60% or higher redemption ratio. September, by far, the majority of the deals saw a 60, and in some cases, 70, 80, up to 93.5% redemption ratio. And in October, we see far fewer deal counts that actually closed, but the redemption ratios for something like a quarter or a fifth of the deals is 80% and greater. So what does this mean? In the short run, high redemption ratios mean that as I said in the beginning, the money that was allocated in the SPAC IPO trust meant for the target company to go public has now been depleted. I also mentioned earlier that PIPE investing, which is often used as a way to supplant the cash that has been redeemed, has been tighter for SPAC sponsors to not only identify, but to actually secure. So in the short run, this has made the job of the SPAC sponsor to close a deal much more difficult. For the target company, it has also meant in some cases that they have to waive the minimum cash requirement that they had in order for them to go public, and to ultimately just make the decision to go public even if that means they have to waive the minimum cash requirement. For the SPAC sponsor, it also means that they likely have to make some concessions around that 20% promote that we mentioned earlier, or they have to overfund the trust, or they have to provide additional coverage and additional rights and warrants for investors in order for them to come in generally earlier at the IPO, and they're known as the anchor investors. In the long run, high redemption ratios generally have shown have been a fairly good predictor of lower de-SPAC performance, so lower performance of the target company. Last thing I want to turn to is where are we with the SPAC market currently? So I mentioned the roller coaster that we've been on, but where are we now and where are we heading? So currently there are more than 600 total active SPACs, 500 of which are pre-deal, meaning they are looking for a company to take public. An additional 300 SPACs are ready to enter the market. Then what I did is I looked at all the SPACs that went public earlier this year. So the SPAC enthusiasm that I mentioned at the start of the year. I also mentioned that generally, right, working off of the assumption that they have up to 2 years to close a deal, I worked backwards. So the wave of SPAC enthusiasm that we saw at the year, that enthusiasm and all of those SPACs have at most 2 years to close a deal, and that 2-year window closes. You can see that in the red bars here, January, February, March of 2023. So that will be the real show me the money moment for SPAC sponsors. Either those deals will close or they will liquidate. And some will also point to US regulatory scrutiny as to what factor that will play in potentially deflating some of the SPAC boom. One other note I will make here is that some market experts and SPAC pundits forecast that up to 50% of the outstanding SPACs will liquidate. But the real question, and I think this is what Usha, Christine, and Stephen will really get at, is whether the incentives to close the deal at any cost are so substantial that effectively those incentives outweigh the market forces and the ability for the SPAC frothiness to essentially self-correct. One final slide. A lot of these questions are also part of the work of the CFA Institute SPAC working group. And I'm happy to share the press release that we put out yesterday with all of this information, but to give you a little bit of information about the work that we've been doing. In May of this year, CFA Institute launched the SPAC working group. The goal of the working group is essentially to go through the discussion that we're having now, but at greater length and with all the SPAC players, SPAC sponsors, financial services providers, academics, and SPAC data research providers. The ultimate work product of the group will be to publish a report in early 2022, along with any policy recommendations on what should be done around SPACs, whether it's disclosure, standardizing disclosure, or some more structural recommendations around the SPAC structure. So with that, I'm gonna end my run through of the slides, but happy to answer any questions, and appreciate the invitation and looking forward to the discussion.
Thank you, Karina. That was very interesting and a lot of information, I think, for everybody. We're going to move on and let our panelists do some opening remarks, and then we'll move into some question and answer. And do remember, you can put questions in the chat as we progress. We're going to start out with Stephen and let him begin with his opening remarks about SPACs. So Stephen, I'll pass it to you.
Thanks, Christine. Let me thank the Atlanta CFA Society for inviting me. Let me also congratulate you on your World Series victory. As a native Washingtonian, I know the joy when the home team wins after a long, long wait. So that was a great presentation overview that Karina gave. I'd like to talk about two basic things. What's the track record of SPACs so far, and where are they headed? Now, as a former SEC staffer, I can't seem to shake the habit of beginning with a disclaimer. And that is that my views do not necessarily represent the views of the SPAC working group that we have, and don't represent whatever our eventual paper will be. I'm just going to try to share some thoughts, and instead of advocating a particular policy position, I'm just going to try to be an honest broker and give both sides and let the audience judge for themselves. So the first question it seems we can't avoid, and that is, what explains the poor performance on average of SPACs to date? There's a seminal paper written about a year ago by Professors Klausner and Al-Rogi and Emily Ruan. It looked at SPAC returns from 2010 to 2018. For every single year in that period, the average post-merger SPAC returns, one-year returns, underperformed the Russell 2000 by 10% or worse. If you compare the average SPAC returns to an IPO index, which went back to 2013, the comparison was even worse. The underperformance was worse. Now, let me emphasize that if you bought any one SPAC back then, today, it may be a great SPAC, but we're talking about the average here. And the paper broke new ground by arguing that it was the SPAC structure itself that explained those returns. And specifically, it found a high correlation between poor returns and the level of dilution. That dilution comes from just what Karina said. There's a SPAC sponsor promote of 20%. They're the warrants that the initial IPO investors get, and they get to keep even if they redeem their shares at a later point. That's the free warrants they get. And this dilution ultimately comes at the expense of the investors in the post-merger operating company. And that includes the retail investors who come in at the time of the merger announcement and hold their shares. I worry that this risk feeds into a larger narrative that the stock markets are rigged. Wall Street wins, retail investors lose. That's particularly troubling for those of us who value capital markets and recognize them as essential for our economy and our prosperity. Now let me switch and say SPACs also have proponents, but let me try to give some of their arguments. Well, first they say that 20% share is clearly disclosed. When investors buy, they know it, and it's their choice whether they want to buy or not. Also, as Karina pointed out, all investors, including the retail investors, can redeem their shares at the time of the merger announcement. Now, there's an argument that SPACs are succeeding in bringing retail investors back into public stock markets, and they're bringing private companies into public markets. It's refreshing them, and the number of total companies has declined to about half of what it was in 1996. Let's remember also that once a company does go public, it's subject to the full force of our federal securities laws with their built-in and robust investor protections, which Usha in particular can articulately describe. Now, promoters also say SPACs are evolving, and in fact, they're evolving right now. And there's an argument they're improving. So don't judge the future crop by past results. Now, I confess that whenever I hear that, I reach for a book on the bookshelf right behind me. I don't know if you can see this. This time is different. And one of the authors of this book, Carmen Reinhardt, has a great line. She says, more money has been lost because of 4 words than at the point of a gun. And those 4 words are, this time is different. And humor aside, financial innovations do evolve. SPACs, as I said, have evolved. So we need to look seriously at the argument, have they improved? And here we're hearing 2 very different narratives. And let me start with a positive one. In the past 2 years, Karina showed the slides there, a huge growth in the popularity of SPACs. It brings in top talent, sponsors with good track records, strong experience, top law firms who insist on accurate and full disclosures for their clients, sophisticated institutional investors who come in at the pipe, invest in the pipe. There's a market argument also that markets are self-correcting. So for example, sponsors may start out with 20%, but they may give up part of that promote. They may subject it to earnouts, that is to performance conditions to be earned. Even bad news can be viewed as having a silver lining. For example, this past September, the Wall Street Journal had an article that said from February to the time of the article, September, about half a year, SPAC, post-merger SPACs had lost $75 billion in shareholder value. Well, that's a lot of money, and it's terrible news for the people who lost it. One might be able to view this as actually having a silver liner, that it's a healthy shakeout that will lead to more sustainable SPAC market. Now an optimistic view, there's also a pessimistic view. And surprisingly, among others, we hear this from some SPAC sponsors themselves. For example, they see completely unrealistic forward-looking projections in SPACs. They say a lot of SPAC sponsors have no business being SPAC sponsors. They don't have the proper experience and qualifications. They voice some frustration at their attempts to distinguish themselves from these other SPACs. This reminds me of George Akerlof's Market for Lemons, which earned him a Nobel Prize in economics. And basically imagine you have in a used car market. There are good dealers sell quality cars. There are bad dealers who sell lemons. Unfortunately, the customers can't distinguish one from the other. So the bad dealers essentially squeeze out the good dealers in this market. You're just left with lemons. So which narrative is right here? Are SPACs improving, or are they producing lemons? We don't know yet. We do know that they're about to enter a critical stage, and we saw this in Karina's slide. There are more than 500 SPACs searching for merger targets. They're going to be under increasing time pressure, scores of them next year, and then a big batch of them at the beginning of 2023. They've either got to find their merger partner and consummate that deal or dissolve. Now, we've heard estimates that perhaps 50% of these SPACs will fail to complete a merger. Now, as counterintuitive as it may sound, maybe that's going to be a good thing if that happens. The bigger risk is that deals go through that are bad deals. So imagine, again, this is hypothetical, but imagine we keep saying 90% redemption rates. Despite the SPAC can't get PIPE investors to come in. The trust funds are all but deleted. And again, only hypothetically, potentially we have some desperate target companies that'll say, okay, let's do the deal anyway. So in that scenario, you've got the misaligned incentives of the SPAC sponsor, of the initial IPO investors who keep those warrants. The deal goes forward. Worst case scenario, and again, I emphasize this is not a prediction, it's a worst case scenario. We could end up with a lot of newly minted zombie public companies. Now, all this presents a lot of challenges to policymakers. I just want to say a couple of quick words and I'll end on that. Well, first of all, with the SEC, if they do nothing and people lose a lot of money, then we'll hear, where was the SEC? Why didn't they do something? They step in now, people will say, why are you interfering with capital markets, with private markets? Let investors do what they think is best. Well, that's not really specific to SPACs. We always hear that. And if you don't want to be in that no-lose situation, you shouldn't be a financial regulator. But specifically with SPACs, we do have some proposals for reform, some policy proposals. I'm not going to go too deeply into depth in this just introductory remarks. I just want to give what I think is a basic challenge. How do we keep the good things about SPACs and get rid of the bad things? And specifically, I'd say three things. One, how do you give retail investors access to early stage high growth companies, but without false promises? Second, how do you give private companies an alternative means to go public, one that they may prefer, but does not bring in public companies that are not ready for that responsibility? And third, finally, how do we allow financial markets to continue to innovate while still protecting market integrity? Thank you.
Thank you, Stephen. And then I will pass it on to Usha and let you do some opening remarks as well. Thank you.
Thanks. Well, first of all, I want to say thank you to the CFA Society of Atlanta. I don't think I've ever spoken to some CFAs before, so this is very exciting for me. And I'm just up the road in Athens. So I started researching SPACs a while ago, 10 years ago, when they were really a backwater. I and my friend and colleague at Baylor University, Mike Stegmuller, who is a finance professor, And we were really just intrigued with this form that allowed, basically allowed the sponsors to take public a company and basically say to the public, hey, give us money. We're going to tie it up for about 18 to 24 months. It'll be safe in an escrow account. And we're going to go on a time limited hunt for an acquisition. And if we find one, you'll get a vote on it, and we'll use the money to fund the eventual acquisition. And if not, you get your money back. So it was sometimes called a poor man's private equity, because it allowed, as Stephen said, this shot for the retail investor to get in on these relatively early high growth companies. Well, SPACs really started to pick up in popularity a few years ago. DraftKings was a big early company in this particular iteration and generation of SPACs. And then with the pandemic, we just saw a lot of companies that were filing initially to go public as SPACs, and then completing what is sometimes which is often inelegantly termed the de-SPAC. That is when the private target merges with the public shell and becomes public. So we saw a real explosion of all of these kinds of transactions. So what I'm going to do is talk a little bit about the IPO process, just to remind some of you of what that looks like, because really the SPAC is in dialogue with and in contrast to the IPO, because as Stephen said, it offers an alternative route to the public markets for a private target. So in the IPO, we have a gatekeeper that designated as such by the 1933 Securities Act. And that is, of course, the investment bank who underwrites the offering. And the act, as I tell my students, very elegantly pins on the underwriter, who's a repeat player with deep pockets, liability, Section 11 liability. So the underwriter buys the shares at a discount, customarily 7% from the issuer, and then turns around and sells them at full price to the market. And the underwriter basically says, yes, everything in all of the S1, all of the filings is complete and accurate. There are no material misstatements or omissions. And if it turns out there are any and the stock drops, then there's strict liability. The underwriter is on the hook, which makes banks very nervous. And it means that they are fly-specking all of the S1s, all of the filings in the prospectus to make sure that everything is accurate, which means that the IPO process is typically slow and costly, probably about $2 million. And so that's the legal risk that the underwriters face. There's also a concomitant financial risk, because as I said, they buy the shares at a discount and then actually hold them and then sell them to the public. So of course they want to make sure they can sell. So how do they do that? Well, by means of, after the S1 is public, they go on a roadshow, they talk to institutional investors, and they finally determine that everything is accurately stated in the offering documents and that there's sufficient demand for a certain price. And they price the shares. And then, as we all know, almost inevitably, there's a pop. The price goes up, which is commonly thought of to be that delta between the offering price and the first day close price is money that's left on the table by the issuer, because the issuer could have priced it higher and gotten that money. Instead, that money goes to whoever bought in the IPO and then sold in the secondary market. Okay, so then a target company is looking at that traditional IPO path. It's slow. And one thing I didn't mention, it's ultimately uncertain. There are times when the IPO window will close. The underwriters will say, we're nervous about going out into the capital markets, and then you can't get a deal done. The SEC's database is littered with S1s of companies that didn't actually successfully go public for a variety of reasons. So in contrast, if a target is negotiating with a SPAC and comes to an agreement, then it has deal certainty. The deal will close for reasons we'll talk about in a minute. And then it also has price certainty. It knows what price it's going to get, which sounds great, right? But the problems have come in, particularly in this iteration, this generation of SPACs, because of an innovation. It used to be, back in the days when I first wrote about SPACs with Mike, that if more than 20% of the shareholders redeem their shares, so, to remind you, the sponsors are on their hunt, they have an merger agreement with the company, and then they put it, the target company, and then they put it to a shareholder vote. And that is also a chance for the SPAC shareholders to redeem their shares. It used to be that if more than 20% of those shareholders redeem their shares, the deal didn't close because there wasn't enough money in the trust account. And that requirement changed for reasons I can go into in the Q&A if you'd like. But the net effect is that we can have what we see today. This is what is really quite extraordinary about today's SPACs and some of those statistics that you saw. You might have seen me chuckle at Karina's statistic of if a 93.3 redemption rate means that 93.3 of the SPAC shareholders took a look at the proposed deal and walked away. They voted for the deal because it went forward, but they got their money out, which is really quite extraordinary. As a financial matter, what plugs that hole is the PIPE, the private investment in public equity. That's what we will talk about with the PIPE. So functionally, that's what happens. This big T. Rowe Price, this other institutional investor comes in and validates the deal. And we can talk about that more later, perhaps. But the concern with the SPAC is that we don't have that gatekeeper. We don't have the underwriter who's making sure that everything's all right. Indeed, we have the sponsors who only get their 20% if a deal closes. The independent directors are paid in founder shares. They only get paid if the deal closes. The investment banks don't get their full underwriting discount, which is typically 5.5%, not 7%. They don't get that full 5.5% unless a deal closes. And we talked about a little bit about the warrant holders. Karina mentioned these. So a SPAC offering, an IPO, is a unit offering comprised of a common stock share and a warrant. A warrant, which is the right to purchase shares if and when a deal closes at 11.5%. So the hedge funds that she talked about, the SPAC mafia, look at SPACs as quite an attractive play because you invest $10 at the IPO, you're going to get $10 back plus whatever interest the SPAC promises. That's safe as houses. And then you have a warrant, which gives you upside if the acquisition goes well and trades above $11.50. So there's this, it's a pretty sweet investment in that there's that safety, but also some upside. But of course, that there's only that upside for the warrant holders if the deal goes through. So anyone that has a warrant and a share is going to vote for the deal to go through. So nobody is stopping to say, it's just is a structural matter. Nobody is stopping to say, wait a minute, is this company ready for prime time? Is this target really going to be a viable public company? And so this is the risk that Stephen talks about, the risk of a market for lemons, that right now on the New York Stock Exchange, we have these companies that have gone through a traditional IPO process, and we also have companies that have gone public by way of a de-SPAC. And he points to those studies that show that the post-de-SPAC companies are underperforming the market as a whole, and also the companies that go public via a traditional IPO. So where are we headed? This is, of course, an important question, and there are two components to that. One, Stephen also sort of referred to this, and this is one of the reasons that the form is so appealing to me as an academic and as a researcher. It evolves, it can evolve quickly, and we can see it real time in a way that we can't see. That the traditional IPO, as I described it, is pretty much a black box until the IPO prices. But in a SPAC, we can see innovation both in the S1 filings that the SPAC makes when it goes public and in the announcements that accompany the de-SPAC. One thing that I've heard is that the SPACs in October, last month, are moving towards a much shorter duration, not that 18 to 24 month that we typically used to see, but more like 14, 15 month. I haven't gotten to looking at those SPACs, but the market is going to react very quickly to what's happening, including this SPAC cliff. The fact that all of these SPACs are looking for a limited number of viable private targets. So we're going to see what that looks like. And then finally, there's legislation pending in Congress, and the SEC is very much looking at this space. They've made some announcements about the treatment of warrants and other matters, and will be doing rulemaking in the spring. And I'm stumbling a little bit because I realized that I forgot to mention in the IPO process another difference between the IPO and the SPAC, which is a very important one, which Congress is looking at specifically. And that is that in general, after the PSLRA of 1995, there was an allowance for a safe harbor for forward-looking projections so that public companies can tell the market about, what they think is coming in the future in terms of financials and softer disclosure. That is not available to the IPO. At least the investment banks really are very uncomfortable with forward-looking projections. And so they're not used in an IPO, but they're very much a part of the current de-SPAC. That's one of the attractions for the target, is that they can tell the market what they think is going to happen in the future. And that's a differential that might be closing with regulation. So that's what I have.
Okay, great. Well, I think we've gotten a really good feel for SPACs and what's going on and some of the issues. We'll dive into a couple more of those issues or a little deeper into them. Stephen, I'm going to ask you a little bit more about PIPEs, the private investment and public equity investors. They've emerged as participants in SPAC transactions more recently. And so what is their function? Are they gatekeepers? Are they similar to underwriters in an IPO, if you wanted to compare them? And then also finally, is this development good or bad for retail investors or for capital markets, as we've talked about valuations?
Thanks, Christine. Well, that is the question. They play a role, and it's a different role than the underwriter in a traditional IPO. Arguably, the PIPE investors give validation to the deal. Their investment, they're putting millions of dollars on the line. They believe the price is right for the target. But if we compare the if we compare the underwriter versus the PIPE investor, the PIPE investors should be sophisticated institutional investors. They really know the industry well. They meet with the target company's management team 2 or 3 times, so they actually assess what they think the capabilities of that management team are. They get to go into a data room, usually see some of the data. Arguably, this is a better way to make a decision than in the roadshow in a traditional IPO that Usha talked about. There, you may be grouped in with a lot of other investors for maybe, 1 hour time slot in a whole series of these 1 hour meetings, 2 hour meetings that take place in a week. So, basically you got 1 hour and you got to make a decision. Arguably, that's not as good and it's not as deep a view as what the PIPE investor gets. But the first point I want to emphasize is that either way, the PIPE investor, this is a business decision. They're deciding whether they should give their money, probably millions of dollars, to invest in this company. Contrast that with the underwriter in a traditional IPO. They're not investing in the business. They're doing what Usha said. Their job is to validate the truthfulness of the disclosure statements that are submitted and filed to the SEC. So they're going to have their own team of lawyers. The argument that they've got the deep due diligence, they've got their own team. It's different from the company itself. So they've got an independent view. they're actually going to visit the company. Maybe they're going to visit the factory. They're going to pore over every single word in that huge S1 filing. And at the end of the day, they're on the hook. So they are representing the truthfulness of the disclosures. And that, again, it's not a business decision. The audience can decide for themselves. Would they have a greater comfort level with a sophisticated investor who's putting their money on the line, or with the underwriter who really has a legal liability for the truthfulness? Let's see, the other thing I would say is that what I described is basically with the ideal. I just give a couple of caveats. It assumes that the PIPE investor is an independent third party set of eyes. That's maybe the case, it may not be the case. The PIPE investor could be an affiliate of the sponsor. They may have other reasons. Maybe they want to develop a business relationship with a target company. Maybe they're getting inducements to invest in the PIPE. So if you're a public investor, you buy it at $10 a share, maybe they're getting $9, $9.50. What's their effective price? It may not be the same as the public investor. And again, the other thing is, your question was, are they gatekeepers? They may give you a comfort level that it's a good deal, but they are in no way representing to the public that this is an accurate and complete public disclosure. So I think I'll end there.
Okay, that's very interesting and very important to know that it's not the same disclosure, and you don't have the same level of comfort in the information that you're looking at between a SPAC and a traditional IPO. Following on that, Usha, I'd like to ask you one of the questions that I had, which was about the structure. We have a lot of players, right? We have sponsors, retail investors, the capital markets, we have pipes, what we just talked about, and we also have anchor investors that are kind of coming into play. Who benefits the most, or who really benefits out of this in this structure? And is any player, and I'm kind of wondering about the retail investor, end up with the short end of the stick a little more often than others? And then if you want to discuss any kind of reform proposals that might benefit or even out that playing field.
Thanks, Christine. So in some ways, if it's a home run investment, then everybody does well. And so you have to think now, how many private companies are out there that are viable public companies that nobody has found yet. But in theory, the sponsors, of course, do very well because they get 20% of the public company after the de-SPAC, after the merger has occurred. The retail investors can theoretically do well. I'm talking about the retail investors in the pre-announcement and then pre-de-SPAC, SPAC can do well, but, and this is the point that the paper that Stephen mentioned makes, the company had you have to think that the combination of being public, the growth potential for the target, and whatever special sauce the SPAC managers bring to bear on that target company is going to increase the value sufficiently to account for that 20% dilution that the retail investors face. I think the banks in general do pretty well. The banks tend to do well. They make their fees. It's true they're not getting the 7% spread, but the IPO process for a SPAC is much, because it's basically a blank shell company, right? So it's a shell company. So all you have to disclose is, here's what we plan to, here's how much money we are making, here's what we plan to do with it, we're raising, here's what we plan to do with it, here's the bios of the directors, officers, management, sponsors, done. I mean, that's a crazy easy IPO S1 compared to an operating company. So I think the allure is that there can be a lot of money to be made, theoretically for all, and for the retail investor, this chance of as Stephen mentioned, investing in these private companies before the market gets a look. However, there is significant dilution. So I talked about the redemption and how there's that problematic incentive where you can vote, you're incentivized to vote for the deal, even if you redeem. And so the paper that I did with Mike shows that an inverse correlation between the level of redemption and the performance of the now newly public company, even 10 trading days out, meaning that if you have a higher redemption rate, then statistically speaking, you're statistically more likely to perform poorly in 10 days, 10 trading days. So our reform proposal is not to let a deal go forward if more than 50% of the shares are redeemed. And that we think will check the market, will allow for some kind of a true market vote on whether or not a deal should go forward in a way that is not potentially tainted as the PIPE validation is, because as Stephen points out, the PIPE investors can get these sort of sweetheart deals that are not available to the retail investors. So they're not investing on the same terms. And part of what that does is address the plight of what I think is one flavor of the most vulnerable retail investor. So, and I picture the retail investor who says, oh, this sounds like a good deal. I have this floor of $10 a share. I have that protection. And so, and there's this fancy PIPE investor. I'm going to invest in this company, and then doesn't redeem either because they missed the redemption date or just aren't paying attention. 93%, those hedge funds, everybody, all the big players walk out the door, and they're left with really diluted shares in this publicly traded company that is statistically more likely to do poorly. So if there's a 50% cutoff, then that shareholder is protected, even if they aren't watching the redemption dates and that redemption decision as closely. So that's why I like that proposal.
So Usha, just to follow a little bit more on the discussion that you were just speaking to, empty voting is kind of what you're alluding to with a lot of this. Would you just explain what empty voting is and the impact on SPACs? And if you would, and maybe this proposal is part of what you're trying to do, or are there other recommendations to eliminate this empty voting, which we know is not a good thing in the market?
So empty voting is something that the law really frowns upon, and that is where you have a vote. So, corporate governance, shareholders have three main rights: the right to vote, the right to sell, and the right to sue. The vote, and you sell, you vote with your feet, but in most cases, if you think the company is bad, then you've taken a loss. So that's not great. But you have this right to vote out directors you don't like, and the right to vote on any proposed merger if you are the target company, if you're being bought. So typically, you need to have an economic interest in the vote, because otherwise, if you have used derivatives to sort of to remove economic exposure, then the law is concerned that there's going to be mischief in how you're voting. You're going to be voting for reasons that aren't driven by economic incentives. And what we have, I argue in the paper with Mike, in SPACs right now is a species of empty voting, where you can vote for the transaction, but then lose all economic interest in it because simultaneously redeem your shares. So one method of reforming this, of solving this problem is not to allow it. To what we say is recouple the economic and the voting interest, and saying you can't redeem your shares unless you also vote no for your transaction, which really just kind of makes sense. It has the beauty of being quite intuitively obvious. But the real point is that the economic vote is the redemption. The redemption is the true vote. So again, I think intellectually recoupling and saying we're not permitting empty voting. If you vote no, if you want to get your money out, then you have to put your voice where your wallet is and also vote no. But you can also do it by just raising the redemption threshold.
Exactly. A very interesting point that goes on with SPACs that we don't tend to see in other parts of the capital markets. Stephen, I'd like to shift gears a little bit, but also looking at some of these same kind of issues and look at venture capital and compare that to SPACs. When we think of venture capitalists, they are SPACs anyway. We look at, they're looking for one single target to acquire, where a venture capitalist is usually going to have a portfolio. So if you'd like to comment kind of risk return on the investment, and compare those two and the dynamics of the transaction when focusing on SPACs.
Yeah, and two things that jumped out at me in what Usha was saying is, one is that it's possible that a SPAC is a home run. And you also said that originally SPACs were viewed as poor man's private equity. Well, in private equity or venture capital, usually you put some money in, but then the PC or the PE or the VC firm has a portfolio of companies. They don't put all their money in one basket. And a lot of them, I mean, Hank Aaron didn't hit a home run every time at bat. And these are not all Hank Aaron companies. So you just hope that the home runs doubles, singles, more than compensate for the strikeouts. So for the portfolio as a whole, you do well. But as you just said, you contrast that with the SPAC, the company is almost always taking just one single company public, one operating company public. You're not getting a portfolio. You got all your eggs in one basket. Now, there's nothing stopping an investor from, say, hiving off a percentage of their total portfolio and then diversifying it by buying a variety of SPACs. I mean, they could create their own diversity, but any one SPAC does not give you that diversity. It's just a totally different business model in my mind.
Exactly, like our Braves and our home runs, right? We could win the World Series, but we didn't hit a home run every time at plate. But we got what we needed. So right, you never know with a SPAC. And we're almost out of time. If there's any questions, please, in the audience, put those in the Q&A and I'll try and get those in. And in the last 2 minutes, I'd like to ask both Usha and Stephen, kind of your thoughts on the future of SPACs. Regulation is obviously being considered. Any things that you think may be coming along the pipe that should be or shouldn't be? I know that's a big question and a short amount of time, but I think it's a nice way to conclude. And whoever'd like to start, maybe Usha, would you like to start first?
Sure. So on Congress's side, it's sort of who knows? Congress doesn't tend to intervene very often in the securities market, and certainly this is a partisan time. I'm not sure that maybe SPACs will be the thing that actually crosses the finish line. The SEC regulation is pretty darn likely, and of course the biggest hammer in the SEC's toolbox is disclosure. So I think we're going to see more disclosure of something that I find very opaque, which is the interests of the sponsor's affiliates, the pipe, any relationships between them. I think that's going to be coming down the pike. There's some cases. So that I think the SEC will take a look at redemption. We'll take a look at the PSLRA safe harbor and trying to equalize the regulation so there isn't what we call regulatory arbitrage, where for a pretty arbitrary reason, SPACs have an easier path to the public markets in terms of regulation than do IPOs. So I think that is coming, redemptions, and then we'll see. I think the form will survive. It's quite adaptable, and there's a lot of this the attraction on the part of getting more companies into the public markets in a different way. There seems to be a lot of appetite for that on the Hill, in the, amongst retail investors. So I think it'll survive with more regulation.
Great, thank you. And Stephen, would you like to comment on that?
Yeah, I basically agree. I guess I'd point to three areas. The first one Usha said is disclosures. And it seems like there's a range of things that could be done. And some I think actually the SEC is doing right now. The staff reviews the filings and they push back. And from what we're hearing, they're demanding, for example, that if there are forward-looking projections on revenue, EBITDA, that the company just explain what's behind their thinking, what's behind those numbers. So that would be just the current thing. The next thing on the subject of forward-looking projections would be to allow them, but to require that they be standardized. And then the third area would be simply to remove the safe harbor so that you have a level playing field. We didn't have time to get into it. I think there are arguments for benefits of forward-looking projections if they're accurate. That's an if. Very quickly, the other thing would be, will there be some form of Section 11 that is strict liability to somebody, maybe the sponsor, the board, an underwriter, whoever, the financial advisors, but will there be some type of strict liability at the time for the merger disclosures, the thing that we don't have that Usha described? That would, I think, be a more aggressive measure. And I guess the last thing I'd point out is that Renee Jones is now the head of the Division of Corporation Finance as a law professor. And a little bit before this, she signed on to a paper with some pretty tough proposals on reforms for SPACs. So it'll be interesting now that she's in the director seat there, what comes out.
Great. Well, very interesting today. I think we covered a lot of material, and I know there's even more that we could have covered. Thank you, Usha and Stephen, and I'm going to pass it over to Celia to close us out today.
Thank you, Christine. And Usha and Stephen and Karina, this was very engaging and hugely informative. I loved it. So thanks to everyone else who connected with us today. Please look for an event survey, which we would love if you filled out, including a replay and the meeting presentation. Thank you so much.